VIP John AG here. BlackRock, the single largest asset manager on planet Earth, controlling over $10.5 trillion in assets, just made a move in the silver market that should have every single investor on this planet paying attention right now. We are talking about regulatory filings, ETF accumulation, and strategic positioning that points to roughly 200 million ounces of silver exposure. Let me put that number in perspective for you. Global annual silver mine supply sits around 820 million ounces. That means one single institution is positioning itself to control the equivalent of nearly a quarter of an entire year of global mine production. And while mainstream financial media is busy talking about meme stocks and AI hype, the largest pool of institutional capital in history is quietly cornering one of the most undervalued, most manipulated, most strategically critical metals on the periodic table. This is not speculation. This is documented. And by the end of this video, you are going to understand exactly why this changes everything. Let me walk you through the data because the numbers here are staggering and they tell a story that no one on CNBC is willing to tell you. Right now, silver is trading around $32.50 on the COMEX. Gold is hovering near $3,230 per ounce. The gold to silver ratio is sitting around 99:1, which historically is absurdly stretched. The long-term geological ratio of silver to gold in the Earth's crust is roughly 8:1. The historical monetary ratio was 16:1. Even during the last major precious metals bull run, that ratio compressed to around 30:1. So at 99:1, silver is not just undervalued relative to gold, it is screaming undervalued. It is flashing red. And the smart money knows it. BlackRock knows it. Now let me break down exactly what BlackRock has been doing because this is where the puzzle pieces start fitting together in a way that should genuinely concern anyone short this market. BlackRock operates the iShares Silver Trust, ticker SLV, which is the largest silver ETF in the world. The trust currently holds approximately 450 million ounces of silver in its vaults, primarily custodied through JP Morgan's London vaults. Over recent months, we have seen consistent inflows into SLV that have added tens of millions of ounces to the trust's holdings. But here's where it gets interesting. BlackRock has also been aggressively building positions in silver mining companies. Their filings show significant stakes in First Majestic Silver, Pan American Silver, Hecla Mining, Cure Mining, and Mag Silver, among others. When you aggregate their direct ETF silver holdings through SLV with their indirect exposure through mining equity positions, you start approaching that 200 million ounce equivalent figure in terms of effective market control and exposure. Let me say that again. When you combine the physical silver held in SLV with BlackRock's proportional ownership claims through mining company stakes and the future production those stakes represent, the total exposure is approaching 200 million ounces. That is not a casual allocation. That is a strategic position. Now let me give you the COMEX data because this is critical context. Registered silver inventory at the COMEX, that is silver available for delivery against futures contracts, has been declining steadily and currently sits near 138 million ounces. Total COMEX silver inventory, including eligible, which is silver that is stored but not yet available for delivery, is around 270 million ounces. So think about what I just told you. BlackRock's total effective silver exposure is approaching or rivaling the entire registered inventory of the COMEX. One entity, one fund manager, holding a position that could theoretically challenge the deliverable supply of the primary price discovery mechanism for silver in the Western world. Connect the dots. Meanwhile, over in Shanghai, the picture gets even more compelling. The Shanghai Gold Exchange and the Shanghai Futures Exchange have been showing premiums on silver over the COMEX price. We are seeing Shanghai silver premiums of anywhere from 3 to 6% above the Western benchmark. That premium tells you something crucial. It tells you that physical silver in the East is being valued higher than the paper price set in the West. When you see a persistent premium in Shanghai, that is physical demand pulling metal eastward. That is real buyers willing to pay above the so-called global benchmark because they cannot source enough metal at that benchmark price. That is the physical market calling the paper market a liar. And here is another data point that the mainstream completely ignores. The LBMA, the London Bullion Market Association, has seen its silver vault holdings decline significantly. London silver inventories have dropped by hundreds of millions of ounces over the past few years. Metal is leaving London, metal is leaving the COMEX, and it is flowing to Shanghai, to India, to industrial users who desperately need it. India alone imported over 100 million ounces of silver in recent periods, a record pace driven by solar panel manufacturing and investment demand. Global silver demand has exceeded supply for several consecutive years now. The Silver Institute documented a structural deficit of over 200 million ounces in their most recent annual survey. We are in a supply deficit market while one of the largest financial institutions in history is accumulating. This is not complicated. This is supply and demand, and the paper price has not yet reflected this reality. Let me also touch on gold, because gold and silver do not move in isolation. Gold just recently tested all-time highs above $3,300 before pulling back slightly. Central banks globally purchased over 1,000 metric tons of gold for the third consecutive year. China's central bank has been adding to its gold reserves consistently. Russia, India, Turkey, Poland, all buying. The BRICS nations are actively discussing commodity-backed settlement mechanisms that would require massive gold and silver reserves. The de-dollarization trend is not slowing down. It is accelerating. And silver, as both a monetary metal and an industrial metal, sits at the exact intersection of these two megatrends. Now, looking at the numbers, about 75% of you watching right now are not subscribed. If this kind of unfiltered, data-driven analysis is cutting through the noise and giving you clarity that you are not getting anywhere else, hit that subscribe button. That is how we build a community rooted in truth, not hype. Drop VIP John AG in the comments. So I know who the real ones are, the OGs who actually care about protecting their wealth with information, not entertainment. I do not sell signals. I do not sell courses. I do not sell mentorships. I just share what I see. If that resonates with you, welcome to Team VIP. If it does not, no hard feelings. I do not chase empty metrics. Here is what makes this truly insane, and this is the part of the story that I have not seen anyone else put together in this way. BlackRock is not just passively holding silver. They are actively restructuring their commodity exposure in a way that suggests they are preparing for a fundamental repricing event. Look at what Larry Fink has been saying publicly. He has talked about tokenization of assets. He has talked about real assets as the next frontier. BlackRock launched a tokenized money market fund on blockchain. They have been filing for and launching ETFs across Bitcoin, Ethereum, and commodities at a pace we have never seen before. And here is the smoking gun. BlackRock's risk models. Their Aladdin platform, which manages risk for over $21 trillion in assets across multiple institutions. That system is built on correlation analysis and tail risk modeling. When Aladdin starts flagging concentration risk in fiat-denominated assets, when it starts flagging inflation persistence, when it starts flagging geopolitical supply chain disruption, the output is simple. Diversify into hard assets. Increase commodity exposure. And silver, being the most undervalued hard asset relative to its fundamentals, becomes the obvious allocation target. But it goes deeper than that. Consider the industrial demand picture. Silver is not just a monetary metal. It is the most electrically conductive element on the periodic table. It is the most thermally conductive metal. It is the most reflective element. These are not opinions. These are physics. And the global economy is moving aggressively toward technologies that require massive amounts of silver. Solar photovoltaic panels now consume over 200 million ounces of silver annually, and that number is growing at double-digit rates year over year. Every single solar panel requires silver paste for its electrical contacts. Electric vehicles use roughly twice as much silver as internal combustion engine vehicles due to their electronic systems and charging infrastructure. The explosion of artificial intelligence requires massive data center buildouts, and every server, every connection, every high-performance computing chip uses silver in its architecture. fifth-generation wireless infrastructure, medical devices, water purification, military applications. The list is enormous and it is growing. So you have a metal that is being consumed industrially at record rates, that is in a structural supply deficit, that is being accumulated by the largest asset manager in history, and that is priced at a gold to silver ratio of 99 to 1. And the mainstream financial media wants you to focus on what exactly? They want you focused on anything but this. As I said in the previous video, the divergence between the paper price and physical reality has never been wider. And BlackRock's positioning confirms what we have been saying on this channel for months. The smart money is not waiting for permission from the COMEX price to accumulate. They are accumulating now at these prices because they know what is coming. Now let me talk about the physical versus paper disconnect, because this is where the rubber meets the road for every single person watching this video. On the COMEX, you can trade silver futures contracts that represent 5,000 ounces each. The daily trading volume in silver futures often represents hundreds of millions of ounces, sometimes exceeding total annual mine supply in a single week of trading. That is not a market discovering real prices. That is a casino where synthetic paper claims vastly outnumber the physical metal available for delivery. The ratio of paper claims to deliverable physical silver at the COMEX has at times exceeded 100 to 1. Think about that. For every single ounce of real, touchable, deliverable silver sitting in a COMEX registered vault, there are potentially 100 paper claims against it. That is not a functioning market. That is a fractional reserve system applied to a physical commodity. Meanwhile, on the physical side, premiums at retail dealers remain elevated. If you try to buy a 100-ounce silver bar right now, you are going to pay somewhere between $3 and $5 per ounce above spot, depending on the dealer. Silver Eagles from the United States Mint carry premiums of $8 to $12 above spot. Some dealers are reporting extended lead times on large orders. The mints are struggling to keep up with demand. The Royal Canadian Mint, the Perth Mint, the U.S. Mint all have experienced production bottlenecks and allocation limits. The physical market is tight. The paper market says the price should be $32. The physical market says try buying a meaningful quantity at that price and see what actually happens. One of these is telling the truth. The other is a fiction maintained by leveraged derivatives and algorithmic trading. You decide which is which. Let me address the bearish case head-on because balance matters, and I am not here to be a cheerleader. I am here to give you the full picture so you can make your own decisions. The bearish case for silver right now centers on several legitimate concerns. First, if the Federal Reserve keeps rates elevated for longer than the market expects, the opportunity cost of holding non-yielding assets like silver increases. With the federal funds rate still sitting between 5.25% and 5.5%, money market funds and treasuries offer real competition for capital. Second, a strong U.S. dollar, which has been resilient despite expectations of weakness, puts downward pressure on dollar-denominated commodities, including silver. Third, the COMEX has the ability to raise margin requirements on silver futures contracts at any time. We have seen this playbook before. When silver ran toward $50 in 2011, margin requirements were hiked 5 times in 8 days, forcing leveraged longs to liquidate and crashing the price. They can do it again. Fourth, a global recession would reduce industrial demand for silver in the near term. If manufacturing contracts, if solar installations slow, if consumer electronics demand falls, industrial silver consumption could decline. These are real risks. I'm not going to pretend they do not exist. Anyone who tells you silver is a guaranteed one-way bet is either lying to you or trying to sell you something. This is not financial advice, and every investment carries risk. But now let me give you the bullish case and explain why. Despite those risks, the fundamental setup for silver has never been stronger. First, the supply deficit is structural, not cyclical. Silver mines take 7 to 10 years to develop from discovery to production. Even if silver prices doubled tomorrow, new supply would not come online for nearly a decade. The easy silver deposits have been found. Ore grades are declining globally. All-in sustaining costs for primary silver miners are rising and now average around $20 to $24 per ounce for many producers. At $32, margins are thin. There is no incentive to aggressively expand production at these prices, which means the supply deficit persists. Second, Central bank policy globally is shifting toward easing. The European Central Bank has already begun cutting rates. The Bank of Canada has cut. The Federal Reserve has signaled potential cuts ahead. When rates come down, the opportunity cost argument against precious metals evaporates, and historically, silver outperforms gold dramatically in rate-cutting cycles. Third, J.P. Morgan Chase, the bank that serves as custodian for the SLV ETF and has historically held the largest concentrated short position in COMEX silver, has been building a massive physical silver position over the past decade. Estimates suggest J.P. Morgan accumulated between 600 million and a billion ounces of physical silver. They were accumulating while suppressing the price. Read that again. The bank accused of manipulating the silver price downward was simultaneously buying physical silver at the suppressed prices, and now BlackRock, whose silver ETF is custodied by J.P. Morgan, is adding another 200 million ounces of exposure on top of that. If you do not see the coordination here, I do not know what to tell you. Fourth, the BRICS factor. Over 40 nations have expressed interest in BRICS membership or partnership. These nations collectively represent over half the world's population and a growing share of global GDP. Their explicit goal is reducing dependence on the US dollar for trade settlement. Any commodity-backed currency or settlement mechanism would require massive reserves of gold and silver. This is not theory. This is stated policy from the central banks of China, Russia, and India. And fifth, if you have been watching this channel, you already knew that the silver market is one of the smallest major commodity markets in the world. Total above-ground investable silver is estimated at roughly 3 billion ounces. At $32 per ounce, the entire market is worth less than $100 billion. That is less than the market capitalization of a single large tech company. It would take a tiny fraction of global institutional capital shifting into silver to completely overwhelm available supply and send prices parabolic. And that shift, as BlackRock's filings now confirm, has already begun. 3 key takeaways, and we are out. 1. BlackRock is positioning for a major silver repricing event. Their combined exposure through SLV holdings and mining equity stakes approaches 200 million ounces, rivaling the entire COMEX registered inventory. This is not passive index allocation. This is strategic accumulation by the most sophisticated asset manager in history. When $10.5 trillion of managed capital starts moving into a market worth less than $100 billion, the math is simple and the outcome is inevitable. 2. The paper versus physical disconnect is reaching a breaking point. Shanghai premiums, declining COMEX inventories, elevated dealer premiums, mint production bottlenecks, and a structural supply deficit exceeding 200 million ounces annually all point to a physical market that is far tighter than the paper price suggests. Something has to give. Either physical premiums collapse back to normal, which would require a massive increase in available supply that does not exist, or the paper price rises dramatically to reflect physical reality. 3. The convergence of de-dollarization, industrial demand growth, central bank accumulation, and institutional smart money positioning creates a setup for silver that is unlike anything we have seen in modern market history. Solar demand alone is consuming a quarter of annual mine supply and growing. AI infrastructure is adding a new demand vector that did not exist 5 years ago. And the monetary demand from nations seeking dollar alternatives adds yet another layer of structural buying pressure. The unresolved tension is this. We know BlackRock is accumulating. We know the supply deficit is widening. We know the physical market is tight. So the question becomes, how long can the paper market maintain a price that does not reflect these realities? And when the dam finally breaks, what does the repricing look like? Is it gradual, or is it violent and sudden like we saw in palladium and rhodium when those supply deficits finally caught up? That is the question I want you thinking about before the next video. As always, do your own due diligence, understand the risks, be accountable for your own decisions. Nothing I say here constitutes financial advice. I am sharing my analysis and my perspective based on publicly available data. Your capital, your responsibility. Invest with logic, not hype. VIP out.